Money has always represented trust. A paper bill, a digital bank balance, or a number displayed on a financial screen has value only because people collectively believe it does. That trust forms the foundation of every modern economy. It allows businesses to trade. Governments collect taxes. Workers receive wages. Families save for the future. But what happens when trillions of new dollars, euros, yen, or other currencies are created in just a few years? Does creating more money automatically make a nation richer? Or does it simply change where wealth flows? The hidden cost of printing trillions is one of the most important and misunderstood economic stories of the modern era. Throughout history, governments have expanded the money supply during periods of crisis. Wars, financial panics, recessions, and pandemics often force policymakers to take extraordinary action. When economic activity collapses, businesses close. Unemployment rises. Consumers reduce spending. Left unchecked, these events can trigger a vicious cycle. Lower spending leads to more layoffs, more business failures, even deeper recessions. To prevent that downward spiral, central banks and governments frequently step in with emergency measures, designed to restore confidence and keep money flowing through the economy. One of the most powerful tools available is monetary expansion. Central banks can lower interest rates, purchase government bonds and other financial assets, inject liquidity into the banking system. People often describe this process as printing money. Today's money creation is usually electronic rather than physical. New reserves are created digitally, allowing banks to lend more freely. Financial markets function more smoothly. No giant printing presses are producing endless stacks of cash. The economic effect is similar. The overall supply of money increases. The logic behind these policies is relatively straightforward. If borrowing becomes cheaper, households may buy homes. Businesses may invest in new equipment. Consumers may spend more. Increased spending supports jobs. It supports corporate profits. It supports economic growth. During severe crises, additional liquidity can prevent widespread bankruptcies. It can stabilize financial markets before panic spreads. This strategy became especially important during the global financial crisis of 2008. Banks faced enormous losses from collapsing housing markets. Lending froze. Confidence disappeared almost overnight. To prevent a complete financial breakdown, central banks around the world reduced interest rates to historic lows. Many introduced large-scale asset purchase programs, commonly known as quantitative easing. Central banks purchased government bonds. They also purchased other securities. They injected vast amounts of money into financial markets. Investors were encouraged to move into riskier assets. These investments supported economic activity. Initially, these policies appeared successful. Financial markets stabilized. Credit gradually returned. Businesses regained access to financing. Unemployment slowly declined. Economic growth eventually resumed. Growth was slower than many expected. Inflation remained relatively low for years. Many economists believed aggressive monetary expansion could continue safely, without significant long-term consequences. Then another extraordinary crisis arrived. The COVID-19 pandemic created one of the largest economic disruptions in modern history. Entire industries shut down almost overnight. Airlines grounded flights. Restaurants closed their doors. Manufacturing slowed. Supply chains broke apart. Millions of workers suddenly lost income. Uncertainty spread across the global economy. Governments responded with unprecedented fiscal stimulus. Central banks expanded their balance sheets at remarkable speed. Trillions of dollars were injected into economies through emergency programs. The immediate objective was clear: prevent temporary disruptions from becoming permanent economic damage. For many families, these interventions provided critical support. Businesses also received emergency funding. Without this support, many companies could have failed. Unemployment could have risen much higher. Financial markets may have suffered a much deeper collapse. In the short term, printing trillions appeared successful. Yet economic policies rarely produce only immediate effects. Money itself does not create goods or services. It does not build factories. It does not produce food. It does not manufacture automobiles. Instead, money changes purchasing power. When money grows faster than production, prices often begin rising. At first, asset prices increase. Stock markets climb. Housing prices increase. Commercial real estate appreciates. Investors become more optimistic because borrowing remains inexpensive and liquidity stays abundant.